In this video, I'm going to show you how you can trade the QQQ or the TQQQ in 2023, whichever one you prefer. I'm going to show you the strategy that I have used for years, but recently I've made some improvements that have made a big difference. I'm going to show you exactly what the strategy is, how you can backtest it, and what to do with this strategy going forward. Stay tuned. Firstly, I'm going to tell you a bit more about the strategy in this video. It is a relative strength strategy, comparing the Qs or the NASDAQ with the SPY or the S&P 500. And the reason for this is that we want to be buying the Qs, effectively buying tech stocks, buying momentum stocks when momentum is strengthening. So we have a clear signal of when to buy and when not to buy. Now I'm using either the Qs or the TQQQ, and I've looked at both. So whether you prefer the leveraged or the non-leveraged version, it doesn't matter. Whether you want to use it using futures, that doesn't matter either. What we're establishing here is a principle to make it easy, a mechanical, algorithmic process that tells you exactly when you can trade and exactly when you should not be trading. What is the trading strategy? Well, it's very easy to calculate in Excel, and I'm going to show you exactly how I do it. First of all, two data sets. I have the QQQ in yellow here on the left, and I have the SPY in orange on the right. Now I'm going to calculate an EMA, an exponential moving average for both of these. Now you can see that if I click in this cell here. You can see I've got an EMA, a 100 period EMA for the Qs. And the next cell, you can see here, I have a 100 period EMA for the SPY. Now the simple thing, the only thing I'm going to do is divide one of these EMAs by the other. I'm going to divide the Qs by the SPY, and this gives me the relative strength over 100 periods. You can see here, all of these cells, if I click into them, are dividing the first EMA by the second EMA. Now the only other thing I do is calculate the day-by-day change of the ratio. So this is this period minus the previous period. And the reason I do that is so I can have a breakdown of how the ratio is changing. The ratio is all that I'm interested in. If that ratio is strengthening, we say the Qs are getting stronger, so we buy. If that ratio is weakening, we say SPY is stronger, so we do not buy. Very, very simple. On this screen, you can see the rest of the trading strategy. We have the entry conditions, the variables, and the exit conditions and the variables. So I'm going to look at both the entry and exit conditions, but I'm going to start off by looking at the stop loss because there is something that I want to show you on this. Now we have roughly the setup that I was using before in this trading strategy. And you can see here, in every trading form backtest model, you can adjust the stop loss. I'm going to set it from a value of 6, which is a 6% stop loss, to 100, which means that it is not active. So you can see here the capital graph adjusted in real time. You can use any trading form model to test, optimize, and refine your stop loss level and decide whether you want one or not. You can see here, strategy capital graph is actually very similar to the underlying market. Now what I'm going to use instead of the stop loss is the trading form strength close, and I can put that on just by checking a box here, and I've set it to a value of 1 and 0.5%. And what this means is that anytime the market moves by just one consecutive bar, one bar of at least 0.5% gain, that means a gain in the direction of the trade, then we exit that trade. However, this particular strength close is only active when the trade is currently a loss. So it works as a backup, as a support, or an alternative to the stop loss. And you can see here the change that it has made to the trading strategy in this case. Okay, the next thing I'm going to do is add in another strength close. Now this one is only active when the trade is in profit. And don't forget, things are different when the trade is a losing trade or when it is a winning trade. Our mindset is different. The way we look at the market is different. So we want to set different values. So I've set this as 3 consecutive bars of at least 0.75%. And you can play around with these values. They're not fixed. You can see here again how it adjusts the strategy in real time. So I'm using these strength closes to improve the performance of the strategy. They're only effective when the price is moving back in our direction. Now let's have a look at the entry conditions. You can see here there's one in particular that I'm showing here, the entry level of 0. This means that the Qs are getting stronger relative to the SPY. Nasdaq is strengthening relative to the S&P 500, which means that we're in a momentum environment and we can trade long. Very, very simple. However, to give you some context, one thing that we've found, that I have found testing the Qs, the Nasdaq over many years, is that it is not a good market to time reversals. We're not doing that because it's a momentum market and it tends to overshoot both to the downside and to the upside. So we've got both of these going on. Momentum style trade means we're looking at a direction and we're investing and we're trading in that direction. However, there is a range. You can get into the trade slightly earlier, and there is good logic to do this. The Nasdaq tends to start its new trends, to start its strengthening from relatively oversold levels. So if we get into the trade slightly earlier, we can get more value from each trade. Now, this is how I compared the entry level and the EMA. This is a new feature in the latest Trading Form backtest models, which Trading Form members have. You can see here we have an optimizer matrix. This is an automated matrix to compare two different variables. So firstly, EMA between 80 and 135. This is the look back period. How far back in time we are going to understand the trend of the Qs and the SPY and the entry level. And we're going here from very oversold to slightly above 0. So slightly early in the trade to slightly late in the trade. And I wanted to test this range to find out where the optimal sweet spot is. And what I found, this is what we've been using before for many years, what I found is going back slightly earlier to a value of 2 or 3. You see here we're getting a lot more green and a much higher return. Going back here, adjusting the entry level. So I've gone to the optimizer, adjusting the entry level to match the optimizer. See how our net profit increases significantly, as does the MAR ratio, all for getting into the trade slightly earlier. You might notice the percentage of winning trades did not change at all. We are wringing out more profit from each trade by getting into the trade earlier. Now, I want to make this a fair test comparing the Qs with the TQQQ, so I'm going to compare it over exactly the same historical period. TQQQ started in 2010, and so I've changed my historical dates. I've used the drop-down picker to select the same historical periods. We're going to be taking the same trades, the same trade entries. Okay, so there's the Qs. We've got 40% winning trades, average trade expectancy 1.2%, and a MAR ratio of 0.93. So pretty decent results over the last 12 years. Now let's compare it with the leveraged version, which I have here already loaded for you. You can see here immediately the capital graph here. We're getting pretty decent results, but we've had a big drawdown. Now we're not at the moment comparing like with like because TQQQ is leveraged 3 times. So as a very rough approximation, we can increase our profit target by 3 times and we can increase our strength close by 3 times. That's all I'm doing, increasing it by 3%. This 3 times. This is not a precise art because the leverage only works over a single day. It's not precise over longer periods of time, but it does give us a useful starting point. Now there you can see we've actually got a trading strategy that is very, very similar. Slightly fewer percentage of winning trades, but I imagine with a bit of tweaking we could get it very similar. My ratio is slightly worse but not too far off. We can probably explain this by the greater amount of volatility, possibly causing some higher drawdowns with TQQQ. But average trade expectancy, a very robust 3%. And the strategy looks pretty good straight off the bat like that, directly comparing it. Now we can change the profit target clearly. And we can see how this adjusts the strategy, like there and like there. You see here, you can get it up, set it up to exactly how you want it. Now, what else can we do? Well, we can go back to our optimizer, which, as I said, is in all the trading form backtest models now. The members can already use this. And I've already run it for you. And you can see here, we actually have quite a different image to what you saw before. But this is because we're using a different historical period. We can't forget that. But just for interest, we can see here, say we decided to go even earlier in the trade. We wanted to go even earlier, set this from 2 to a value of 5. Key thing to remember here is getting in earlier. See here, percentage of winning trades is roughly the same. However, the amount we're eking from each trade by getting in earlier is better. See here, slightly better MAR ratio, slightly better average trade expectancy. So you can see here both the Qs, this strategy is on both the Qs and the TQQ. It is working well. Let's have a look at this strategy going forward. Let's have a think about it. We can never predict the future. Whoever says they can, I wouldn't trust them if I were you, but we can make some educated guesses based on what has happened in the past. In other words, our analysis and our backtesting that we've just seen, and also just thinking about it logically. So the first thing to note is that tech stocks are in a bit of a funk at the moment as we enter 2023. So we've seen all of them announcing job losses and reductions in future expectations for profit. So the price has fallen, which has dragged down the NASDAQ, which is the primary way that we are taking these trades. Is this going to change in the future? Well, probably yes, and it depends on your perspective. If you're going to want to trade tech stocks, NASDAQ, when momentum has started up again, then this is the strategy for you. At the moment, we're not getting good trades. Buy the dip was thoroughly tested and busted in 2022, particularly for momentum stocks. Had a very, very tough time. It may change in 2023, but waiting until the market is getting stronger by using the strategy that I've just described, in other words, waiting for this ratio to strengthen, can give you a signal of when it is safe to get back into the market, when it is worth taking a risk on these potentially very profitable trades. I hope you found this useful. Please subscribe, please like this video, please subscribe to this channel for lots more videos like this about backtesting the trading strategies, about becoming a better trader, about getting more winning trades. And for more information about trading the financial markets, please go to tradinformed.com.